Last week held great significance for US monetary policy, with the market responding to the FOMC meeting by making clear they expect an end to the tightening cycle within months, with rate cuts to follow. But thereafter, January non-farm payrolls printed at almost 3 times the consensus estimate as the unemployment rate edged down to its historic low. Monetary policy's effect certainly comes with a lag, but we have to assume that these outcomes are at least incorporating the neutral monetary policy setting established around 6 months ago. Abstracting from month-to-month volatility, it seems fair to conclude that economic policy and the end of the service sector reopening has materially slowed job growth. The 3-month average change in non-farm payrolls falling from 561,000 in the first quarter of 2022 to 356,000 in the 3 months to January 2023. Also notable is that throughout 2022, there was a sustained divergence between monthly growth in non-farm payrolls at 401,000 and household survey employment, which is circa 264,000, at least in part because many US workers need to hold multiple jobs to have enough income to live, a perennial feature of their economy. While the monthly pace of job creation remains a multiple of the 100,000 the FOMC believe is consistent with a balanced, non-inflationary labour market, it is notable that wage growth is showing no evidence of accelerating. Rather, it is in retreat. Average hourly earnings rose 0.3% in January, a sub-4% annualised pace. Moreover, the average of the past 6 months has been broadly in line with this pace, bringing annual growth down from the cycle peak of 5.9% in March 2022 to 4.4% in January. Disproportionate growth in low-paid jobs is likely biasing total hourly earnings growth down, but adjusting for compositional changes via the Employment Cost Index, it is evident that both wages and total compensation growth staged a material retreat over the 6 months to December 2022. In particular, private sector wage growth slowed from a 6% annualised pace in the June quarter to a 4% annualised pace in the final 3 months of 2022. Clearly, the US is not experiencing a wage price spiral, and there is no evidence of one forming. What are the implications of these developments for activity, inflation and policy? For consumption, at best, households find themselves with unchanged levels of real income since before the pandemic and a historically low savings rate. It is not surprising then that goods consumption stalled in the second half of 2022 and growth in services consumption more than halved during 2022. Together with declining housing investment and very weak business investment, a stalled economy through 2023 seems most probable, arguably with downside risks. For inflation, the net effect should be a broadening out of the disinflation seen in the goods components of the CPI in late 2022, allowing headline inflation to sustain a circa 2% pace on a 6-month annualised basis in 2023 and bringing annual inflation back near that pace from mid-year. For the FOMC, the market's response to the January payrolls outcome will help to keep financial conditions at a contractionary level, with real yields positive across the curve. But, given the detailed outcomes for activity, wages and inflation and the lags with which policy impacts, it does not justify the FOMC being more aggressive. We remain of the view that one more 25 basis point hike in March will bring an end to this tightening cycle before a lengthy pause of policy until rate cuts begin in 2024. The FOMC may decide to add one extra hike in May on risk management grounds, but the consequence for term interest rates and the dollar from such a decision will be immaterial, with peak Fed funds firmly in the market sights. For sustained market concern over rates and growth to be seen, there will need to be a clear upturn in wages and inflation. We'll see you next time.